In what is sure to be a relief to mortgage holders everywhere, the RBA has paused. The RBA has left its official cash rate at 3.6%, although the RBA did leave open the possibility of an additional rate hike or two if conditions don't improve. Now, despite the fact that the RBA didn't increase rates at this meeting, rates have increased some 3.5% over the past year, in our steepest rate hike trajectory ever, and this hasn't been great news for mortgage holders, many of whom are still on fixed rates and are facing a massive mortgage rate cliff. However, that notwithstanding, it's worth looking at why the RBA paused and what they indicated about what is going on in the economy. And if you've got any thoughts about this, let me know that in the comments below. So what exactly did the RBA say about inflation, interest rates, and the economy? Well, in their statement, when they went through why they kept the cash rate at 3.6%, the RBA specifically said, this decision follows a cumulative increase in interest rates of 3.5 percentage points since May last year. The board recognizes that monetary policy operates with a lag, and that the full effect of this substantial increase in interest rates is yet to be felt, i.e. they're making reference here to the mortgage rate cliff that many mortgage holders are going to suffer. The board took the decision to hold rates steady this month to provide additional time to assess the impact of the increase in interest rates to date and the economic outlook. In essence, the RBA wants to see what is going on in the economy before making further rate hike decisions. This in particular is off the back of that banking crisis that went on in the United States, which has potentially tightened credit conditions within the US, which will feed through into Australia. The RBA also talks about inflation and their inflation target. They state the board's priority is to return inflation to target. High inflation makes life difficult for people and damages the functioning of the economy. And if inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger increase in unemployment. The board is seeking to return inflation to a 2 to 3% target range while keeping the economy on an even keel. But the path to achieving a soft landing remains a narrow one. That is, the RBA is laser focused on getting inflation back down toward its target. And while they would like growth and unemployment to remain relatively in line with what they would like, relatively benign, there is always a risk that when they're getting inflation back down toward target, unemployment does ultimately have to start creeping up. The RBA also flags the possibility of further rate hikes, stating, the board expects that some further tightening of monetary policy may well be needed to ensure that inflation returns to target. The decision to hold interest rates steady this month provides the board with more time to assess the state of the economy and the outlook in an environment of considerable uncertainty. In assessing when and how much further interest rates need to increase, the board will be paying close attention to the developments in the global economy, trends in household spending, and the outlook for inflation and the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. That is, even though there's been a pause in interest rates at this particular meeting, there is the possibility of an additional hike, possibly 2 additional hikes, if inflation remains entrenched and if inflation doesn't go back down. Now, the RBA's job isn't being helped to what's going on with OPEC, for example, where OPEC has recently cut oil production by another 1.16 million barrels per day, on top of a further 2 million barrel production cut that they made earlier on, and a 500,000 barrels production that Russia cut from supply, increasing to about 3.7% of global oil demand. So the RBA's job is suddenly being made difficult, or made more difficult, by some of these global factors. The RBA then digs a little bit deeper into the economy, stating, a range of information, including the monthly CPI indicator, suggests that inflation has peaked in Australia. Goods price inflation is expected to moderate over the months ahead due to global developments and softer demand in Australia. Meanwhile, rents are increasing at the fastest rate in some years, with vacancy rates remaining low in many parts of the country. The prices of utilities are also rising quickly. The central forecast is for inflation to decline this year and next, to around 3% in mid-2025. Medium-term inflation expectations remain well anchored, and it is important that this remains the case. So there's a few things to unpack here. Firstly, talking about what's going on with prices more generally, inflation being quite high but coming back down, although obviously subject to some of the issues with OPEC that I talked about. Rents have been increasing, but it's important to note that landlords are not making out like bandits from this. After all, many landlords are paying significantly higher costs, and rents are not increasing nearly enough to cover those costs. So those landlords themselves are going to suffer a diminution in spending power. Furthermore, the RBA is suggesting that inflation is going to remain relatively high for some time. They're also focused on inflation expectations. That is what consumers expect will happen with inflation within the economy. After all, if consumers start to bake in incredibly high inflation expectations, then those consumers are going to start spending as if inflation is going to take hold. This then drives more current demand, which then, ironically enough, forces up prices, triggering the inflation that they themselves had feared, creating a bit of a vicious spiral. So therefore, the RBA is at pains to avoid those inflation expectations getting out of hand, thereby exacerbating the whole situation. The RBA also talks about growth in the economy. They say the growth in the Australian economy has slowed, with growth over the next couple of years expected to be below trend. There is further evidence that the combination of higher interest rates, cost of living pressures, and the decline in housing prices is leading to a substantial slowing in household spending. While some households have substantial savings, others are experiencing a painful squeeze on their finances. And it is good that the RBA notes this. They've noted that, in fact, there's lumpiness in consumer savings, and there's lumpiness in the financial situation of many households. In particular, households that have large mortgage debt are particularly vulnerable to the impact of these higher rates remaining higher for longer and the mortgage rate cliff that they might ultimately suffer. Furthermore, as I indicated, even though rents have increased, many of the people who own those properties are not actually making any more money from this because that money is often going out on interest rates or expenses for builders or various other things that have all increased. And this is ultimately weighing on growth. We've seen consumer spending, consumer expectations, and consumer sentiment all go down rather strongly, suggesting a general feeling of negativity about what is going on in the economy. The RBA also talks about wages, which is obviously important due to both unemployment issues and also due to what's going on with inflation. After all, the RBA has noted that there's a very tight labour market, but they've also noted this tightness can cause wages to increase. And the RBA is watching out for a wage price spiral, which would ultimately feed into inflation. The RBA says on this, wages growth is continuing to increase in response to the tight labour market and high inflation. At the aggregate level, wages growth is still consistent with that inflation target, provided that productivity growth picks up. The board remains alert to the risk of a prices-wages spiral, given the limited spare capacity in the economy and the historically low rate of unemployment. That is, if unemployment remains very, very low, and we don't get a greater supply of workers to perhaps offset that somewhat, then there's a possibility of ever greater wages causing ever greater inflation in a vicious cycle, which is something the RBA would rather like to avoid. So when we put all of this together, we can see that the RBA is taking a cautious wait-and-see approach. They're cognizant of the fact that many of their measures are still yet to have a full impact on the economy. In particular, many people on fixed-rate mortgages are going to face the impact of these higher rates. They just haven't done so yet. And when they do face that impact, that could potentially catastrophically affect consumer spending because many of those people will now suffer a massive reduction in their disposable income. This will affect not just owner-occupiers, but also landlords, who are now going to have to spend significantly more money in order to prop up a property in order to subsidize the tenants within that property. And as a result, we're going to potentially see more weight on the economy, and the RBA is very cautious about this. Certainly, the banking crisis in the US is also likely to weigh on this somewhat, although that banking crisis should not be overstated. After all, the banking crisis has an impact on those regional banks, but the Australian banking sector is relatively strong, and in addition to this, the main impact on Australia is in terms of a tighter supply of credit within the US, which can feed through into the cost of capital in Australian banks. But the RBA is clearly watching out for this. So overall, that seems to be what's going on with the RBA's decision, and why it is that they decided to pause on their rate hikes at this particular meeting, but why it is that there's still a possibility of an additional rate hike or two if inflation doesn't start heading back down in line with what the RBA would like to see. Now, if you've got any thoughts about the RBA's decision here, or about what they should be doing with monetary policy, let me know that in the comments below. I'd be interested to hear your thoughts as well. But otherwise, don't forget to subscribe. Thanks a lot for tuning in, and hopefully I see you next time as well.